Hi, I'm Helen from Time 2 Resources. This video will help you to understand gearing. This is one in our series of financial ratios. If you want to make notes as you follow the video, why not download the PDF note taker? The link is available in the description box below. Gearing is a measure of the debt to equity ratio of a business. It identifies the percentage of a business's capital that is funded from long-term loans. Debt is finance raised from loans and is therefore compulsory interest bearing. What this means is that even if the business is not making a profit, it still has to make repayments and pay interest. Equity is finance raised from investors in return for a share in the business. Debt is creditors, it is a liability. Equity is from shareholders, they are part owners of the business. The information needed to calculate gearing can be found on the statement of financial position or balance sheet of a business. In order to calculate the gearing ratio, we use the formula non-current liabilities divided by non-current liabilities plus total equity times 100. Non-current liabilities are the items that a business owes that it has more than 1 year to repay. For example, a long-term bank loan. Total equity is the total of the shareholders' capital and reserved profits within a business. Let's look at an example. Elliott's is a national chain of bakeries. On its statement of financial position, it shows it has non-current liabilities of 233 million and total equity of 329 million. We apply these numbers to our formula. 233 divided by 233 plus 329 times 100 gives us 233 divided by 562 times 100 gives us an answer of 41%. This means that 41% of Elliott's capital is from non-current liabilities. In the examination, we often get a question where a business has an objective of growth and is considering an appropriate source of finance to fund this investment. Here, Elliott wants to grow the business and it plans to invest 60 million in opening new stores. This will be funded through debt. In questions like this, the examiner is looking for you to show off your quantitative skills by calculating the new gearing ratio. Why not pause the video whilst you try to calculate the new gearing ratio? Let's have a look. You should now have the non-current liabilities of £293 million and the total equity of £389 million. A common mistake made by candidates in examinations is that they forget to add the 60 million to both the non-current liabilities and the total equity. If this was done in the real world, the balance sheet would no longer balance, so it's important to remember to add the additional capital to both the non-current liabilities and the total equity. Our calculation now is 293 over 293 plus 389 times 100, which gives us £652 million on the bottom of our formula, and we can see that as a result of funding the expansion by debt, the gearing ratio has gone up to 45%. Let's look at how we could use this information to start to develop an argument. We're looking to have an argument that includes analysis, i.e. a logical chain of argument, and application, i.e. it is written in context. We can see in red here that we have 4 pieces of information in our short paragraph that we can use as application. On top of that, we also have the calculation we have carried out, the fact that gearing has increased from 41% to 45%. When looking at gearing, most students identify the fact that if a business is highly geared, this is considered to be high risk. Unfortunately, few students go on to explain what is the risk associated with being highly geared. Let's have a look at how we can develop our argument. Elliott's plans to invest 60 million in opening new stores. This will be financed by debt, e.g. a long-term bank loan. The long-term bank loan is just adding a little bit of further understanding to the term debt. A consequence of this is that gearing has increased from 41% to 45%. We are bringing in the answer from our calculation. This increases the risks of the business. Many students stop there. What we want to understand is why and how does it increase the risks of the business, and what was the impact of this on Elliot's. So let's continue to develop our argument further. Meaning that if interest rates were to rise, it would experience a rise in costs, as 45% of its capital is from sources that are compulsory interest bearing. We have recognised here that interest rates are a cost to a business, but the risk only comes if the interest rates are to rise. This could lead to lower profits, meaning that they have less retained profit to reinvest at the end of the year, which may hamper their ability to fund future growth, affecting Elliot's ability to meet its long-term objective of growth. We've brought our answer back to why is this a risk? Well, it might stop the business from achieving its objective. We identified the objective in the paragraph where we showed in red an objective of growth. When we're looking at gearing and talking about risk, there are lots of lines of argument that we could develop. We could talk about profit or profitability, the fact that a highly geared business will have high interest payments. These are a cost to a business, so they would affect net and operating profit and net profit margin or operating profit margin. That the interest payments are a cash outflow to a business and therefore would affect the cash flow forecast and the closing balance at each month. That it would affect break-even. The break-even level of output would increase if interest rates were to rise. This may affect the business's competitive advantage, particularly if it passed on rising interest rates in the form of higher prices to the customer. It may affect the margin of safety. If the break-even level of output has gone up, the margin of safety will have come down. And finally, it may affect a business's objectives, their ability to survive, to make a profit and to grow. However, there is also a risk if a business has too low a gearing ratio. There may be missed opportunities. Maybe it's not taking enough risk in order to expand and grow the business. So, what were the key points in this video? Gearing is a measure of the debt to equity ratio of a business by identifying the percentage of a business's capital that is funded from long-term loans. The formula is non-current liabilities divided by non-current liabilities plus total equity times 100. The information for this calculation is likely to come from an extract of a business's statement of financial position, which can also be called the balance sheet. A business with a high gearing ratio may be seen as taking too much risk, and we can analyse that in relation to various points, including profitability, break-even, and objectives. A business with low gearing may be seen as taking too little risk, as it's not willing to invest in expanding the business. Thank you for watching this video. Remember, this is just one in our series of understanding financial ratios. So if you haven't already done so, why not subscribe now to the Time to Resources YouTube channel?